Gold is sitting at a critical level right now, and what happens next could trap 90% of traders. This is not just price movement, this is institutional manipulation in real time. In this breakdown, we're going to think like institutions, not retail. We'll decode structure, liquidity, and reveal high probability setups with precision. Let's start with a higher time frame because this is where the real story begins. On the 1-hour chart, structure is clearly bearish. We're printing lower highs and lower lows, a textbook downtrend. This break of structure confirms seller dominance. Institutions are in control, pushing price lower with intent. Before the drop, we saw a change of character, signaling the shift from bullish to bearish intent. This zone above is institutional supply. This is where smart money sold aggressively. That high is weak, meaning liquidity is resting above it. Price is likely to revisit it later. Below current price, we have a strong low. That's where liquidity sits and institutions are targeting it. So overall, the higher time frame narrative is bearish. And until structure shifts, we favor shorts. Liquidity is the fuel of the market. Equal highs and lows are magnets where stops are placed. Retail traders buy breakouts and place stops below lows. Institutions hunt these stops. They push price up, trigger buy orders, then reverse hard. That's manipulation. This sideways movement is distribution where smart money unloads positions. The goal is simple: take liquidity above, then drive price into sell side liquidity below. And now price is approaching a critical demand zone. This is where the market decides continuation or reversal. Now let's move to the 15-minute time frame. This is where we refine entries and track real-time behavior. Price is consolidating, building liquidity on both sides. This strong bearish move shows momentum, sellers are still active. Below this area, liquidity is stacking. Stops are waiting. Notice the weak bounce, buyers are struggling. This favors continuation. Minor shifts inside, but no strong bullish confirmation yet. Price might still sweep short-term highs before dropping again. This area above is a sell zone. Institutions may revisit it. This slow movement is absorption preparing for expansion. Breakout traders will get trapped here if price reverses. A strong rejection here confirms continuation downward. This is the key demand. If it breaks, we accelerate lower. Next, liquidity sits around 4,650. That's our downside magnet. Now let's talk execution. This is the sell setup institutions are likely waiting for. Entry between 4,700 to 4,720 after liquidity sweep and rejection. Stop loss above 4,740, invalidation of bearish structure. Targets at 4,670 and extended target at 4,650. This gives us a clean 1:2 or better risk to reward setup. Now let's consider the alternative, the buy scenario. Buy from 4,660 to 4,670 if strong reaction appears. Stop loss below 4,640 below strong low. Targets at 4,700 and 4,730 if momentum continues, but only if we see strong bullish confirmation, otherwise avoid longs. Pro tip: always trade where liquidity is not where it already moved. Never trade against higher time frame bias without confirmation. Fake breakouts are opportunities, not signals. Bearish bias overall, sell from supply or buy only with strong confirmation. If you want to master smart money concepts, this is just the beginning. Subscribe now and it'll show you how institutions really move the market.